Last week, we expected a decline. It happened. We had a target of 39.50, went to 39.47. So it was pretty accurate. And what now? Right, we've been saying for the longest time market's going higher, and February pretty much went down, although it didn't go down dramatically. It's actually quite boring. We're looking for a rally into the middle of March. It should start this week, possibly the 27th or 28th. There's a good chance that this rally is a B wave of some sort, which means the February decline from February 2nd was an A wave of a three-wave correction. The B wave will take us up higher. Should take us above the highs, but it may not. At least should be visible as a meaningful rally, and it should go on until at least the 16th, probably the 22nd or 24th of March. And then it should be followed by a big decline, which would be the C wave of this correction that started in February, ending late April, early May, potentially around May 3rd. That seems to be coming up. So we're looking for a rally starting this week, potentially. It could drag out, it could go sideways or even slightly lower until the 8th of March, which is another week. It may go up and down, chop around a little before it gets going. But it should rally in March, at least the first half, possibly all the way to the third week of March, followed by a sharp break into early May. Okay. Now that I got that out of the way, I wanted to say a lot more. We've had this class going on. It's the second week now. It's been very successful. One of my students mentioned that, this is a seasonal and that's a seasonal, and there's all these different things that are considered and measured, and every statistic under the sun is measured about what happens on February 10th, February 11th, where the big rallies and declines are, where the big swings are generally, whether the first half of the year is up or down. All of these statistics that are very well known are measured based upon the solar calendar, based upon a 365-day, 12-month calendar. All of that relates to one cycle, the yearly cycle. It's all measuring internal structure of the yearly cycle. The yearly cycle has seasons, and so these are called seasonal. You've heard the expression, sell in May and walk away. Turns out if you buy in October and sell in May, you make a good deal of the money that you can possibly make. So there are other seasons. There's other cycles, okay? Turns out we know about the election cycle, the 4-year cycle, and the midpoint of the 4-year cycle is at the midterm election, and then the presidential election after that is the next high point. So you buy between the two elections at the halfway point, at the midterm, and then you sell at the high point of the next election. And that's historically remarkably good. It's done over and over again. You see this chart, we have a 20-year cycle as the starting point, the 20-year cycle high that started in 1920 to 1940, 1940 on, 1960 on, 1980 on, the year 2000 going forward, the year 2020 going forward. Each of these 20-year cycles you can see laid out in their full duration. And you'll note that at the 4-year point, starting from the midterm of one of them, every 4 years, which on this chart would be about 1,000 bars, 250 bars per year, 1,000 bars. It turns out the 700th bar is one midterm, and then 1700th bar is another low, and then 4 years later, the 2700th bar is another low, and the 3700th bar is another low, and the 4700th bar is another low, for a 12, 16, 20-year cycle, 5 of them, and they're all meaningful lows. Notice that after each of those lows, the market tends to go up. Here's a blow up of it, the 4-year cycle, numerous repetitions of the 4-year cycle, and notice around the midpoint you have a low, and then for at least a year, sometimes all the way up to the 2-year point, you have a rally. So that's another season, okay? There are bigger cycles. There are cycles of 12 years, and there are cycles of 80 years and 40 years and 100 years. Each one is divided into sections. There's a huge cycle of, you've heard about the yugas, in the Vedic system, they talk about a 4 million year, 4,320,000 year cycle divided into 4 sections. You've heard about the contradive wave, where a 52-year cycle is divided into 4 sections, in winter, spring, fall, and summer, okay? So there are many different seasons. It's not just the seasonality of one cycle, there's a seasonality of each cycle. And so the trick is, which cycle is which? Where are we in each cycle? And the whole trick here is to know which season we are in which cycle. And then knowing that, you know whether the market is going to go up based upon this one and down based upon that one. It's called wave mechanics. You add it together. So either you can put together the sum of all the different seasons and know which season is which, or, I can't help but say this, or it becomes the season of the witch and you lose all your money. That was a great song by Donovan in the 60s. So the bottom line is, how do we avoid having to learn all of this? Well, some people, and I, of course, am a teacher who teaches all about these various cycles and how to combine them. But some students are not that eager to learn the details. Some people just want the trade. They just want to know what to do. So now, finally, we're going to be offering on our website, we're going to be offering my 12-wave model, which combines 12 different cycles. And when the majority of them are up, it goes long, and when the majority of them are down, it goes short. It roughly trades over about twice a month, about 2-week swings, although sometimes they're longer and sometimes they're shorter. And it has been consistently making money for at least the last 10 years and most of the last 25 years on the S&P. And most recently, the last 5 or 6 years, is making a tremendous amount of money. So I wanted to offer it to the public. It's not been available before, and you can research it and get more information on our website, which is listed in the link below. So on that note, I also wanted to point out that there is a very clear repetition. We've been seeing the 1934 market has been repeating, and notice it's at a point where we have a low, it goes sideways to up, which would be our B wave rally, and then it calls for a decline, which would be the C wave decline that we're expecting in April, followed by the beginnings of a rally. And we've already shown this chart 10 times, that the second half of the year we expect a big bull run, or at least a meaningful rally phase. All right? So remember, check out the link below for more information on the trading, and also to view our website, which has just showed up this week.